Hello and welcome today to Protective Strategies, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I am joined today out there in the chat by my good friend Cameron May, 20-plus year veteran of the financial markets, education coach and also senior manager, and well suited to help answer your questions. And certainly welcome to all of you that are joining us today, whether you're watching live, whether you're watching the recorded version. And it looks like we've got a lot of new folks today, which is phenomenal. So welcome to all of you. If this is your first time, of course, our usual suspects are here. So thank you guys for coming back. Today, I thought we would, since we do have a number of new folks on board with this discussion, my thought was we would take the idea of one of the protective strategies that we discuss on a fairly regular basis, the collar strategy, and we'd break it down into a step-by-step process, and then maybe throw a variation on there at the end. So stick around. There's that little nugget at the end of this discussion, and we'll jump into that here really quickly. A couple of things, though, that we need to talk about as we get started for housekeeping purposes. First of all, remember that this particular webcast is designed as an intermediate to advanced webcast. Now, that being said, like I mentioned, we're going to start at the beginning. We're going to break down this strategy into its parts and do this step by step. So for those of you that have never traded options before, stick around. You're going to learn something. For those of you that have been doing this for a while, you stick around too, because we're going to have a couple of variations that you'll want to pay attention to along the way. Now, a couple of quick reminders. Everything we talk about simply for illustrative and educational purposes only. It is not a recommendation, not advice of any kind. Remember also that options are or do carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Multiple leg option strategies will involve multiple commissions. Spread trading, which we're not really going to talk about today, but we will have some components of that, must be done in a margin account. Remember that anytime an option trader is short an American style option, that option could be assigned early, in fact, anytime up until expiration, regardless of whether that option is in the money, at the money, or out of the money, does not matter. Now, there are a lot of different ways to look at the market. We're going to primarily focus on technical analysis in this discussion. There are other means of making investment research decisions. None of them are guarantees. None of them tell the future. All of them are theoretical in nature. Remember that Schwab, however, does not recommend the use of technical analysis as a sole means of investing research. Now, we're going to use the thinkorswim desktop software platform today. That's going to be the primary focus of this discussion in terms of the mechanics of what we do. However, it's not a guaranteed future success out there in the real world. It's a great learning environment, but it also doesn't do a couple of things like facilitate the early assignment of those short options that we were talking about. So as you move your practice from paper money trading to live trading, that is something to be aware of. Remember that investing involves risk, including the loss of principal. Past performance of any security strategy doesn't guarantee future results or success. And one of the things that we're going to compare and contrast in this discussion today is the idea of a stop order or a stop loss order. Remember that stop orders, stop limit orders, they do not guarantee the execution price. You may be able to specify the activation price, but they don't guarantee at what price that order is going to get filled. So that is something to pay attention to. Now, we're probably not going to talk about futures in today's discussion. We have in the past, but just a quick reminder in case it does come up. Remember that futures and futures options trading involves substantial risk. It is not suitable for all investors. Make sure that you have read and understand the risk disclosure statement for futures and futures options prior to trading any futures products. So here's who I am really quickly. Again, as Cameron pointed out in the chat, you can follow us on X, formerly known as Twitter. My handle is at Ben Watson CS. Cameron's is at Cameron May CS. I've been an education coach here since 2005. I am the host of Your First Trade, which is a show that appears on the Schwab Network. Now, the Schwab Network is brought to you by the Charles Schwab Media Productions Company. It is a separate but affiliated subsidiary of the Charles Schwab Corporation. The Charles Schwab Media Productions Company, not a financial advisor, registered investment advisor, broker-dealer, or futures commission merchant. But that's where you can see me, as well as live events, as well as webcasts on an ongoing basis. So let's talk a little bit about where we are headed in this particular discussion. And as we jump into this process, we're going to talk a little bit about what protective strategies are. Remember, I mentioned that we're going to focus primarily on callers today, taking that step by step. We'll look at how we might approach that application and then put some examples together in the thinkorswim desktop software version of the paperMoney platform so that we can evaluate those examples and take a look at the mechanics of the process. So really quickly, we're going to focus primarily right here. This is going to be our immediate focus. Again, if you are brand new to the idea of trading options, again, welcome and thank you for being here. We've got some additional resources that I will point out as well, but our focus is going to be on callers. We're going to use a combination of selling a call option as well as purchasing a put option to buffer downside stock risk, mitigate, manage, not eliminate, but a few other different words that we could use here. The strategy attempts to cover the cost of the put by selling a call. So we're going to try to accomplish the idea of a low or no cost caller strategy to help, again, buffer some of that potential risk. And it has its challenges, right? One of the challenges is that it potentially limits upside stock gains. So let's jump in to the platform here really quickly. I'm going to switch gears. I'm going to switch over to the thinkorswim desktop software platform. Again, this is the paperMoney version. This is a demonstration account, so it's made to look like a live account. It is not. I assure you that it is not a live account. Now, as I'm doing this is a good reminder for me to ask you to click on that subscribe button down at the bottom of the page if you have not done so already. If you're brand new here today and you're just joining us for the first time in this webcast because of an email or something else that brought you to this webcast, a great way to stay connected is to click on that subscribe button. If you've been here before and you just haven't done it, it's no cost to you to click on that subscribe button. It allows you to set up alerts and stay connected to what we're doing as far as educational content here at Schwab Coaching. So with that said, let's take a really quick look at what's going on in the market at the moment. And we take a look at the S&P 500 here, kind of booming out of the gate here. We saw a little bit of a gap up and a rally today, potentially moving up above some previous resistance levels. And that previous resistance level, in this particular case, perhaps supporting the idea that there is some bullishness coming back into the market, whether it's because of potential for rate cuts, whether it's the jobs data that's coming out on Friday, whatever the reason, I don't know, right? But the market has been on a pretty big bullish run off of this bounce from the 50-period simple moving average, continuing that bounce today. Now, that might start us to think about, well, wait a second, why should we be thinking about protective strategies when the market is just rocking and rolling to the upside here and it's breaking out above a resistance level and it looks strong and healthy and bullish? But the phrase that I like to use in this particular webcast is that sometimes the more prudent time to buy an umbrella is not when it's raining, but when the sun is shining, because that's when umbrellas are less expensive, perhaps, right? or maybe it makes the most sense so that you're prepared and ready when the rain does inevitably come at some point, right? Now, I'm not saying that the market is going to turn around at this particular point. The market may turn around. There's no guarantee of that. Technical analysis doesn't strive to predict the future, but it does give us a decision-making framework around which we as traders can make decisions in the event that something does happen. So maybe a more prudent time to buy umbrellas or buy protection is when the market is moving in a bullish direction, or in other words, when the sun is out and shining. So SPX kind of making that move to the upside. Now, with that being said, let's kind of go step by step through this process of building a caller strategy. So we're going to take a position. I'm going to use an example of a stock that I already own in this particular demonstration account. And we're going to look at the opportunity of selling a call or creating a caller strategy around that option. So I'm going to switch gears to a different grid chart. And it's just a simple grid that has candlesticks here on the chart. But this is a stock that in this particular portfolio, we already own 150 shares, if I remember correctly. If we go over to the monitor tab, yeah, we've got 150 shares of stock. Now, one thing to consider, since we're talking about selling call options, which is similar to a covered call, if we own the underlying stock, then the minimum in terms of position size that would need to be owned to provide cover for that short call would be 100 shares of the stock, given the standard option contract size of 100 shares. So in this particular case, we own at least 100 shares of this underlying stock. So we're going to go back to the chart here and kind of take a look at what's going on a little bit. And what I'm going to do, again, if this is your first time here on the thinkorswim platform, we've got some great webcasts that can help you to get oriented to this platform as a tool. I'm going to let Cameron put the links to that out in the chat, because quite frankly, he teaches a bunch of those specific webcasts in helping you get oriented to using the thinkorswim platform and using charts and using the tools that are here. So I'll let him put that out there in the chat. But one of the things that I notice is this particular chart kind of running up into the top right corner of this chart, the visible chart area at the moment. That doesn't give me a lot of room to demonstrate. So watch what I'm going to do. I'm going to click right here on the gear icon up at the top of the chart, which pops up that little menu that says chart settings. I'm going to open up this chart settings dialog box, and I'm going to go to two places. The first place that I'm going to go is price axis. So I want to give myself a little bit of headroom to the upside so that I can demonstrate, we can talk about this caller strategy and demonstrate it on the chart. So I'm going to give myself about 20% of room to the upside. And I'm going to click on apply, and you can see how that gives me a little bit of room to the upside. The other thing that I want to do is I want to go to the time axis. Now, I've already got 10 bars or days in this particular case, because it's a daily chart, out into the future to the right-hand side. I want to give myself a little bit more because I want to be able to draw some lines out there into the future. So I'm going to actually go 50 bars out to the right. So we're going to give ourselves 20% to the upside, 50 bars to the right. We still get to see all of the view of the chart. We just add a little bit of space over here to the right-hand side. So now, you know, we could probably make the argument, we could probably draw some diagonal trend lines here that suggest that this particular stock continuing to make higher highs and higher lows. That might be one of the reasons why we own it in this particular portfolio. Other traders might have other reasons for owning this stock or not owning this particular stock. We're not going to get into the fundamental aspects of that. We've got some great webcasts that can do that. All right. So that being the case, now, if we own this underlying stock, one of the things that I notice is that this is kind of echoing what the price of the, or what the overall market is doing today. So the first step that we might take in creating this caller strategy is to determine at what price levels we might choose to put the collar strategy together. So the collar incorporates two things, okay? So the collar strategy is going to incorporate two particular ideas. One is the idea of a short call, and the other is a long put, okay? So we're going to sell a call and we're going to buy a put option. Short being sell, long being buy, right? We're going to create that platform or that process. So short a call and long a put. The short call creates an obligation to deliver the shares. The long put does two things. One, the long put provides some buffer if the price of the stock goes down, because a long put option generally, theoretically, gets more expensive or more valuable if the price of the stock goes down. But the other thing that the long put does is it specifies a particular price at which the trader could choose to exercise their right to sell the shares of the stock to somebody else, okay? So it defines our level of risk in this particular case, right? So now let me kill that annotation really quickly, and we'll come right back over here. And we'll say, all right, at what point do we want to define where those levels are, right? And I want to go to Desiree's question really quickly here. Can you only put calls? Can you only buy or create calls and puts on individual stocks? And the answer to that is kind of a complex question. There are products, and we're not going to talk about those particular products in this particular webcast, although we do have webcasts that do talk about that are optionable, that do replicate or try to emulate the performance of a market as a whole. And sometimes you could create a collar type of strategy on those products. You could create a collar or a spread type of trade on something like an index, but we've got to remember that indexes and index options are generally cash settled, and so that doesn't necessarily accomplish the same purpose. But that's a great question to ask, right? Okay, so what we're going to look at doing here in this particular case, the step one is defining what levels we're going to establish this collar strategy. So some traders may use previous levels of resistance and support to help define where that risk or where those levels might be, right? So some traders might say, taking a look at this previous resistance that we have here right around that 225 mark and saying, hey, look, this looks like potentially a level of resistance. And we might want to use either that level of resistance or some level above that as a means to define our risk. In this particular case, and for this particular example, here's what I'm going to do. I'm going to look at selling a call option up here around that 230 level. And the reason for doing that is that if the price of the stock were to break through that resistance and continue to move, I've given myself a little bit of headroom for the stock to move up before it would get to that in the money position, right? Before the price of the stock would move up and through the short strike. Doesn't mean that the option couldn't be assigned early, because it could, but it gives the stock some room potentially to continue to move to the upside, right? Now, the other side of this coin is where we might put the protective put. So this is going to be our sold call, right? So this is going to be the short call up here right around the 230 strike. Now, where a trader puts the protective put is a matter of how much downside move they're willing to perhaps to accept. So if we were to choose the break of perhaps a support level, that might be a reason to maybe look at exiting the position or managing the risk, or using that as the level at which it would the put option would offset some of that downside movement. So what I happen to notice is that right down here at about this 210 level, maybe even a little bit lower. Let's go down to that 205 strike level. That 205, I've got a pretty good level of support that's fairly well defined. And if you want more information about how to determine where levels of support and resistance exist, Cameron's got some great videos in his webcast series, Getting Started with Technical Analysis, that talk about how do you define levels of support and resistance. So I'm going to come over here. We're going to put our labels on here really quickly. We're going to say we're going to sell a call here at 2:30. Okay. And we'll put that sold call up here. And we're going to buy a put right here. Okay. We're going to buy a put at that level right there. Now, what that does is it means that the price of the stock has the opportunity to continue to move higher or lower before it runs into those levels. It gives it some range to move, but it also buffers downside risk, and it limits potentially, one of the trade-offs here is that potentially limits that upside movement, because the stock could be called away, right? That's the obligation that we enter into when we sell the call option. So selling a call, buying a put, that's kind of step one, establishing those levels. Now that we know that, step two is determining how far out in time we want to keep this protection in place. So that becomes a little bit nebulous, right? Because I don't know how long a thunderstorm might last if that thunderstorm comes. So how long I'm going to have the umbrella in place may be variable, right? And one of the things to think about is that putting this particular collar type of strategy on isn't something necessarily that a trader will do all the time, having that collar in place. Some traders do. But if the stock is making strong moves to the upside, the collar strategy is going to be a drag on that potential gain in the underlying stock. So when the stock's going sideways, when the stock is pulling back, or when there's that little rumble of thunder over the horizon, like there might be here, that might be the circumstance and the time to put that collar strategy in place, but doing it within a time frame that makes sense so that things could be adjusted. We'll talk a little bit about that as we get further on into this discussion. So in this particular example, here's what we're going to do in terms of step two. We're going to go to the trade tab for AMAT, and we're going to take a look at how long we might keep this strategy in place. So we might look at going out maybe as far as 3 months in keeping this collar in place. I'm going to go kind of to the shorter edge of that. I'm going to go just a little over a month. We're going to go to this 12 July expiration. Now, it's a weekly option. That simply means that this is an option that expires on a Friday that's not the third Friday of the month. And we're going to open up that expiration, the 12 July expiration. And we're going to keep this protection in place. Theoretically, we could keep it in place all the way to the 12 July expiration. But because we can choose to take this trade off or take this strategy off, it doesn't mean that we have to be in that trade all the way out to the 12th of July. So we know that just by cross-checking here, our levels, we're looking at the 230 call and about the 205 put strike. So let's go back to the trade tab here. And so what we're going to do is we're going to look first at the call option. And so if I look at the 230 call option right now, creating that trade, I can sell, in this particular case, that 230 call for about $5.90. Okay. And that gives the stock about $5 or $7 in this case of headroom to the upside. Okay. So I'm going to look at doing that first. And the way that I'm going to do this is I'm going to hold my control key down and I'm going to left click, right? I would left click that 230 call option. Okay. The bid price for that 230 call. If I were to leave it right here and just go confirm and send and click through this order, this would be a covered call, right? And many of you are familiar with trading covered calls perhaps already. So if I were to just leave it there, that would be creating a covered call. But we're going to use the proceeds, some of the proceeds of selling that call option to buy our protective put. So in this particular case, we're going to go to the 205 strike on the put side, which is over on the right-hand side of the option chain. And I'm going to hold my control key down and I'm going to go to the ask price and I'm going to left click on the ask price. And now what I've done is I've created a combo trade, right? Selling the call option at the 230 strike and buying the 205 put strike. Now, because that call option is more expensive than the put option, this is going to end up being a credit, okay? And again, this is another one of those scenarios. If you notice what's been happening with this call option, it's been or with the price of the stock, it's been moving higher. Call options get more expensive and more valuable when the price of the stock moves up. So we're selling an expensive call option and buying a relatively inexpensive put option, which is resulting in a net credit for this combo trade. So I'm going to go back to the trade tab, and here's my order, and I'm going to click on confirm and send. Okay. So what this does, what this combination trade does, is it's going to put those two together. I'm going to bring in a credit of $3.67, or in other words, $367. Now, there are a couple of things that we need to pay attention to here. One is this maximum theoretical profit, and that maximum theoretical profit assumes that we don't own the underlying stock. So does this maximum loss, because the price of the stock could go up. But since we already own the shares of the underlying stock in the same account, then once we create this order, it's going to match up with those. Now, one of the things that I'm going to do, and again, remember, this is an intermediate to advanced level class. I'm going to click on the edit button here. I'm going to right click and I'm going to send this order to the analyze tab. Okay. And so we're going to take a look at this combo trade, this collar strategy, along with the ownership of the underlying stock. Okay. So what we see, because remember, we've got 150 shares of stock here. So we've got a little bit more of a bullish bias because we're not hedging off or buffering the entire position in the underlying stock, right? So as we start to make this or put this trade together, I can actually in this chart take that stock out of the position, and you can see what the risk profile graph looks like for the combination. Gives me an absolute price there at the 230 strike, and it gives me an absolute price there at the 205 strike, right? But I put it in combination with the stock, and you can see that it buffers some of that potential loss in the ownership of the stock, but it also defines a theoretical maximum gain in the price of the underlying stock, right? So if the price of the stock goes up, the collar might be a bit of a drag on that upward movement. But in putting this trade together and going back to our trade tab again here, creating this order now offsets some potential downside movement, gives us the right to sell the shares at 205 if the price of the stock go down, and it creates an obligation to deliver the shares at 230. If we wanted to eliminate that obligation, we could simply buy back the call side of this particular trade. So step one was define our levels. Step two was determining at what time or what expiration we were looking at creating this collar. Step three, putting the order together. Step four, confirming and send, making sure that we're aware of any transaction costs or any alerts, and then clicking on send to fire that order off, and we'll see if that order fills. All right. So to answer a couple of questions that are going on in the chat, they asked question, is AMAT Applied Materials, is that a bullish trade? Well, so we kind of have to define that, right? So is this in a bullish uptrend? It's making higher highs and higher lows, right? So yes, at the moment, this is a bullish stock. We're putting on this protective position, this collar strategy, as a means to help offset a potential reversal of that trend, but it comes with an associated cost or risk, which is that we could have to deliver the shares of the underlying stock. Now, for some traders, that might be okay. For other traders, this might not be the strategy that they want to put on, because we have to ask the question, is this a stock that we really, truly, honestly feel comfortable selling if we're obligated to do so? And that kind of has to be part of the internal conversation that a trader has to have in putting this strategy together. So we'll take a look at our monitor tab here, and we see that that combination trade is working here. I'm going to right click and I'm going to cancel and replace this order. We're going to open up the limit here, kind of reduce our credit a little bit, see if we can get this order filled so that we can see it. I'm going to click on confirm and send, read through the order again, make sure that I'm aware of any alerts, and I'm going to click on send and fire that order off. We'll see if we can get that order filled. Okay. So that's a kind of step-by-step primer for putting together a collar strategy. Now, does it have to be on a stock that you already own? No. So I've got a couple of other examples here, and let's take a stock here in this particular example. Let's take GM as an example. So I'm going to come back over here to the chart. We're going to take a look at GM. And so here's a stock, once again, making a general, let me change this to drawing a trend line, making a general upward trend, higher highs and higher lows, for whatever reason, still running into perhaps a bit of a resistance level up here around 46 or so. Price of the stock kind of trending underneath that level, but it's pulled back a little bit, maybe looking for a bit of a bounce here in this particular case, and the possible breakout. So again, step one, determining at what levels we might put our call option in place, at what levels we might put our put option in place to provide that protection. So in this particular case, I'm going to give this a little bit more room to move to the upside. We'll look at maybe selling out to the 50 strike. That gives that stock just about $5 of headroom to the upside. And we'll look at buying the put option maybe right down here around this 42 level if we've got that level of granularity. We might have to go up to the 45 or down to the 40, depending on the width between the strikes that we might have. So now that we know that kind of that first step, what we're going to do with this trade, we don't happen to have a position on this stock. We don't already own the stock. So we're going to come back over here and we're going to go to the trade tab for GM. And what we're going to look at doing in this particular case, actually, I do own the shares of the stock, but we're going to add another 100 shares here just as an example. So what I'm going to do is I'm going to change the layout just a little bit. Okay. So instead of buying the stock and then creating that combination trade, what I'm going to do is I'm going to change this spread in my option chain. I'm going to change that from single options, and I'm going to change that to collar with stock, because I'm going to buy 100 shares and I'm going to sell the call option and I'm going to buy the put option. So now the next step is determining how, our combo for AMAT just filled at $3.54. Okay, so now we need to determine how far out in time we want to create that collar. So once again, I'm going to go out to this 12 July, about 37 days to go until expiration. We might even go out to, you know what, let's do this. Let's go out to that 19 July. We still have dollar-wide increments in our trade. So we know that the stock is trading right around that 45 level. So we kind of need to scroll down here to see where we are, but we're going to look at selling. Again, we said, let's just cross-check against the chart, selling at about the 50 strike level. So I'm going to go back over here and we're going to look right around that 50 strike level. Now, this is going to be a debit trade. This is going to be money out of pocket because we're buying the underlying shares. So I'm going to come over here to doesn't matter if I go to the call or the put side, but I'm going to go to the ask price because we're going to be buying the shares of the underlying stock, and we're going to be now kind of adjusting this trade to match our expectations, right? So we're going to sell the 50 call, but we also said that we're going to buy, in this particular case, well, let's just cross-check that against the chart. We were going to buy the 42 put. So let's go back to the trade tab, and let's adjust the put strike, and let's go down to the 42 put, okay? So now what this order is doing is it's looking at buying the stock, selling the call option, and buying the put option. Now, the stock's currently trading at $45.61, and we're able to do that for a net debit of $45.67. So this is essentially a no-cost caller strategy. It's not giving us a credit, but neither is it really costing us. It's costing us about 7 cents to create this caller strategy. So we're going to click on confirm and send. We're going to read through this order. And now this order, because we're doing this all in one, now this does associate our ownership of the stock. And it says our maximum profit on the trade is $433. That assumes that the price of the stock goes up and through that 50 strike and is called away. Our maximum loss is 367, which assumes that we exercise the option at 42 and sell the underlying shares at 42. And we're doing that for that investment in the trade of $4,567. We're going to read through that, make sure that we're aware of any transaction costs and any alerts that might be here. And we're going to go ahead and we're going to click on send. Before we do that, I'm going to click on edit, right click. We're going to send this over to the analyze tab, and you can see that risk profile graph of that position. So I'm going to take our long stock position off. And for those of you that might be familiar with trade, with more advanced option strategies, what essentially this does is it creates a synthetic. Buying the underlying stock, selling the call option, buying the put option creates a synthetic long vertical spread. In this case, a synthetic long call vertical. So that's kind of what we're creating here in this particular strategy. So we'll go back over to the trade tab. We'll click on confirm and send, read through that order, click on send, and we'll fire that order off. And what we did is we bought the underlying stock, we sold the 50 call, we bought the 42 put, and now those options are in place to help buffer downside movement in the price of the stock and upside potential. Now, the other thing I want to do here, and I want to go over here to the monitor tab so that we can see how these look. If I go to the monitor tab and I look at that GM position, now what I notice is that I've got the caller strategy, and that caller strategy shows me the trade price. So we ended up buying the stock, selling the put, or excuse me, selling the call, buying the put option for a net of $45.72, and that's gone down a little bit because the price of the stock is coming down a little bit. The options are changing. The AMAT trade, if we come back over here, we can see the cost of the combo. We brought in $3.54. If we were to buy it back right now, we'd be paying $3.75 to buy that combo trade back. So the price of the stock is kind of adjusting a little bit on us here as well. So that's how those are going to appear in your monitor tab as you put those together. So what I want to do here is I've got one other particular stock here, and that is Costco. And I'm going to go to the chart really quick, and we're going to go to Costco. Remember I said that we're going to have a variation of this caller strategy. So now what we're going to think about doing here is, since we own shares of Costco, we've got to determine at what point we want to protect it to the up, or put that risk into the upside, that obligation. And so the stock's trading at 829. Let's give it a little bit of headroom. Let's look at selling the 850 strike. Okay. And let's use the level of support, maybe right down here around the 790 level, if it were to break down below that 790 level. So that's what we've got in place. So what I'm going to do is I'm going to go over here to the trade tab. And one of the questions that oftentimes comes up is, do I need to align the expirations of the call option with the put option? And the answer to that is no. So we could look at buying a longer dated put option. So in this case, I'm going to go out to the 16 August, cross-check against the chart. We're looking at the 790 strike. And so I'm going to look at, let's make these singles again. Let's look at buying the 790 strike out 72 days to go until expiration. And so I'm going to click on that. We'll put that in as our first leg here. And then what I'm going to do is I'm going to look at selling a shorter dated option to provide that protection. So we might go here to one that's about 2 weeks out. That's 16 days to go until expiration, the 21st of June. So I'm going to look at selling the, what did we say? The double check, the 850 call option. So we're going to look at selling the 850 call, and we're bringing in about $5.40. So this is going to be a net debit. I'm paying a little bit more, but that put option is going to be in place for a longer period of time. The call option, I then have the opportunity perhaps to sell another call option before that put option expires. I'm going to click on confirm and send, make sure that I'm aware of the transaction costs here. But what this becomes a little bit more like, for those of you who are trading advanced option strategies, this becomes a little bit more like a bullish, or basically a bull call diagonal spread. So we're going to go back to the trade tab. We're going to click on confirm and send, read through the order, click on send, and fire that order off. Now we've put that in place. So listen, we went through that relatively quickly, but we broke it down step by step. If you want to learn more about these strategies, come on over to youtube.com/@TraderTalksWebcasts, and you can learn more about protective strategies or any other topic. If you want to learn a little bit more about options, this is a great place to do that. And if you go to schwab.com/coaching, then you've got our full calendar of webcasts, live events that you can see going forward. You can even go back, but this is where you can register and set up those alerts and so forth. So some great resources to be able to continue your learning. So we focused on callers. We broke it down into a step-by-step process. Determine the levels, determine the time, put the trade together, place the trade. That's the step-by-step in this particular case. Now remember, there is risk in this strategy. It may provide a drag against the upward movement of a bullish stock, but it could potentially also buffer possible downside movement as well. So it's a strategy that some traders may employ. You don't have to, but think about this, that maybe the prudent time to buy an umbrella is when the sun is shining and not when it's already started to rain. So once again, my thanks to my good friend Cameron May for helping out there in the chat. Follow us on X @BenWatsonCS, @CameronMayCS. Remember to click on that subscribe button if you have not done so already. Guys, you've been great. Thank you for joining me today. Thanks for being here. And I look forward to seeing you in other webcasts as well. Have a great day, everybody. Thanks to our great production staff for bringing you this phenomenal event today. Have a great day. Bye-bye.